Welcome to the First Time Homebuyer Workshop with Julie Marion, where today we'll be diving into one of the most critical aspects of buying your first home, affordability, and what first-time homebuyers don't know but should. You're probably feeling a mix of excitement and anxiety, and it's totally normal, but let's be real. The one thing that could cost you big is if you don't fully understand the factors of affordability. Most home buyers focus on the mortgage, but affordability goes far beyond that. And if you're only looking at the monthly payment your lender gives you, you could end up regretting it later. In fact, more than 50% of first-time home buyers experience home buyer's remorse, and a lot of it comes from underestimating the true costs, but it doesn't come from just one place. The true cost of affordability. When people think about home affordability, they focus on that mortgage payment, as I just said. The monthly payment your banker gives you. Yes, they do estimate some of the expenses like property taxes, but if you are using an online service provider or a huge bank located in another state, most likely the estimation will be wrong. Additionally, there are other costs of owning a home that rise each year, which you can rarely control. I've seen heating bills go up fourfold within 3 years, inflation skyrocket, and property taxes more than double. All of those expenses are part of the definition of affordability. You will hear terms like house poor, where you have worked so hard to buy and then you just feel bad because you are house poor. There isn't any money left over for your life if one or two of those necessary expenses rise a lot. And as you know, the devil is in the details. So let's explore this concept and how to become part of the 32% of first-time homebuyers that do not experience homebuyer remorse. A key tip: gross versus net income. According to the U.S. Department of Housing and Urban Development, HUD, your housing costs shouldn't exceed 30% of your income. But here's the catch. Lenders base this on your gross income. That's not the money you have in hand every month. After income taxes, insurance, and retirement deductions, your actual net income can be much less. And suddenly, that affordable mortgage doesn't feel so affordable anymore. To avoid becoming house poor, where you can afford the mortgage but struggle with the other financial obligations, it's essential to do the math based on a blend of the gross income and your net income. It's not one gross income or the other net income. The key is the blend of the income. And here's why. Tax advantages and amortization schedules. You have to look at the big picture. Home ownership comes with tax advantages like you can deduct annually your mortgage interest payment from your taxable income. To be comfortable financially, you will either need to buy well below what you can afford, or you'll need to run hypothetical tax scenarios, which is more likely. If you run these hypothetical tax scenarios, then you will need to look at your loan amortization schedule as well as your property tax deduction. Understanding how much interest you'll pay will help you understand how much of the tax benefit applies to your monthly income. This is a step that goes well beyond what your mortgage broker will tell you. It's up to you to make sure you're financially prepared. Planning for the long-term affordability. This is never discussed. Affordability isn't just about getting approved for the loan. It's about ensuring that your home remains financially sustainable over time. Too many buyers find themselves stretched thin trying to cover all the ongoing costs. Consider the true long-term costs of owning through what I call a forecasted budget. A forecasted budget is an action step that can put many first-time home buyers in the driver's seat. As reported by the Wall Street Journal, buyers often face repair bills within the first year that can range from $2,000 to $10,000, depending upon the age and the condition of the property. Not to mention, last time I walked into a home, there was furniture, curtains, household goods, appliances, and well, if you want to paint, you get the idea, right? This needs to be included in a forecasted budget as well. Here are 3 out of the 5 variables that you need to account for that rise in cost. Property taxes. Property taxes are often glossed over during the home buying process. Real estate agents and mortgage brokers rarely discuss these future increases in property taxes because they don't want to blow the deal and it's not really part of their responsibility. It takes time to go and get the information. And also in many states, it's buyer beware. So they are looking to you to do this research. How do you know to ask if you've never done this before? We will be diving deep into property taxes in another content piece, but know today, right now, property taxes, these taxes are not static and they can rise substantially. Depending upon the area's property value reassessments and the budget needs, the property taxes fluctuate, especially if you're in an area that's funding a new school or infrastructure projects such as water treatment plants. The framework of how a geographic area, whether it is town, county, or city, the functioning aspect of that comes from the revenue of the property tax base. Property taxes are based on the value of your home, and this value may be out of date when you purchase. Many local jurisdictions reappraise homes every 3 to 10 years, so that can be a rising cost down the line. During this lag, the assessed property value may not reflect the true market value. If your home is reappraised after you purchase the property, you may find yourself paying a significantly higher rate sooner rather than later. And remember, just as I mentioned, property taxes up to a specific dollar amount are tax deductible. And also, many jurisdictions increase taxes incrementally as capital improvement projects are brought online and completed. That's why reading about the activities going on in an area and attending a few public hearings is a good way to get a heartbeat on what's happening budget-wise. Realistically, property taxes easily double every 10 years or so, or they stay stagnant and then they really hit because the local government hasn't been collecting enough. Next, homeowners insurance. Insurance premiums are rising thanks to inflation, supply chain issues, and climate change. The Insurance Information Institute reports a 12% increase from 2017 to 2021, and it's worse in disaster-prone areas. The natural disasters such as hurricanes, wildfires, and floods have caused significant damage in recent years. Insurance companies either raise the premiums or they just leave an area and they no longer provide insurance. For example, in Florida, where hurricanes are frequent, some homeowners have experienced a nearly 30% increase in premiums over the past 2 years. It seems to me too, whenever I turn on the news, there are flooding and fires and reported all the time. This is an upward trend that is expected to continue, and insurers face growing risks and financial losses from extreme weather events. These events are very unpredictable. The cost to rebuild homes has risen due to inflation, supply chain issues, and labor shortages. According to Versic Analytics, a company specializing in risk assessment, rebuilding costs increased by 9.3% in 2022, contributing directly to higher insurance premiums. These rising costs can significantly impact your monthly budget as a homeowner, especially when combined with the other expenses like property taxes and mortgage payments. If for some reason the prices don't rise, well, then you can pay down the mortgage or you get to do something else with the extra cash. Let's talk about maintenance and repairs. You will hear people cite unexpected repair and maintenance costs. Well, it's not really unexpected. The condition is right there for you to see, but you don't know because you are new to this. You just need to know what to look for. According to the National Association of Home Inspectors, 40% of buyers find significant problems. That's a lot. 40% of buyers find significant problems after they move in. Who tells you that when buying a house? Think leaky roofs, old HVAC systems, or faulty wiring. That adds up fast. Even newer homes can have hidden issues. So in addition to your full-time career that got you to this place where you can buy a home, you also need to be a builder, electrician, plumber, pest control, carpenter, and energy expert. And home inspectors are not allowed to quote prices on repair costs, so don't rely on them for estimates of future expenses. Now, this might be silly, but do you feel hopeless and a little overwhelmed? Imagine all of this is thrown at you while you're going through the home buying process. Yes, it's overwhelming, but I'm here to tell you there is a way out. Buying a home is an excellent long-term investment. So, what do you think I'm going to say? Well, you will hear people say, be realistic. It's an easy word to say, and it's so annoying. At least I think so. But do not feel bad about this, first-time buyers, because all this stems from the fact that you are not given the correct education. It's never explained to you. There's no college course. You'll likely be working with transactional professionals, real estate agents, mortgage brokers, and others whose main goal is to get the deal done, not necessarily to look out for your best interests. These professionals may not have expertise or the incentive to delve into specifics of future costs, leaving you to face unanticipated financial burdens down the line. They hide behind, well, that's not my area, and truthfully, time is money. They need a lot of transactions to make a living, and this is really where the rubber meets the road. That's why it's so important to be fully educated before stepping into an open house or calling a mortgage agent. If you aren't prepared, it could cost you thousands of dollars and years of regret. Not to mention all of the arguments you will have with yourself and if you're buying the property with someone else. Homework. Yes, you have homework. For today, start paying attention to the Federal Reserve's report on the economy and inflation, as these components will directly impact your ability to obtain a mortgage. Mortgage rates are always changing, and being informed will give you an edge. By planning ahead and doing the math, you'll be that 32% of first-time home buyers who avoid first-time home buyer remorse. Empower yourself and check out our free class, Homebuying Chaos Unwrapped, to get a solid foundation on the process before you dive into house hunting. Remember, you have been promoted to CEO of your home buying journey, and as a first-time home buyer, the knowledge you gain now will save you headaches and money down the road. Until next time, from the team at the First Time Home Buyer Workshop with Julie Marion, bye for now.